These are some new strategies for 2021. I'm going to go over each one of these. First one is gap, continue, and reverse. And we've been working on these for several months and some different ideas we've had. And this is a strategy that basically looks at this pattern. It doesn't catch it perfectly, but we're talking about the pattern where you have in the market where the market gaps down, it continues, and then it reverses. So one of the toughest patterns to catch. And last Thursday, this strategy would have captured this move. We weren't trading it. And here's some recent trades. It did not capture it here. It doesn't get the low, and it's difficult to get the low, and I'll explain a little bit more why. But you see it also goes short. And so this is only for a gap down. This does not work for a gap up. It's hard to trade a short trade if it gaps up. It's possible it could work in the future. But what we have here is what happens is if the market gaps down, it continues, and it's above the 1% down on the day. If the current price is greater than being down 1% from yesterday's close, then it will work that gap continuation in reverse. Now, if it's below 1%, it's down 1% or more, then it will short rallies. So see here, finally it breaks down. So we don't try to catch a long trade on a gap down when it continues if the price is lower than 1% down on the day. I found that to be too much like catching a falling knife. Now this can short it. So you're talking about here you see it shorting, and so it has a tighter profit target on the shorts than the longs. And so that could also be something that could be adjusted in the future. The concept could work on the short side on a gap up in the future. The market is so biased to the upside, it does not work when you trade this to the short side on a gap up. So here are the results. Here's the equity curve. You see that since 2016, this has done really well. The periodical returns on the year, 23,887.50 on 154 trades, over $200 average trade profit. And this is with slippage and commission. So I'm taking out slippage and commission, $25, and that 48.42 is going back to 2007. And it includes this time period right here. That average trade profit includes this time period. So since this time period, average trade profit is much higher, drawdown is much smaller. I'm going to adjust the performance summary so you can see that. And you can take a look at the long trades, 25 with a $19,000 drawdown. And that's historically before 2016. So since 2016, about the last 5 years, it works better. And then the short side actually works. So really like how the short side sets up. And as we roll into a market environment that could be more bearish or have gap continuations and reversals, this is a strategy to trade. We've seen lots of gap continuations in reversals in 2020, and since the pandemic, March and April not much, but there's that May and June time frame where this pattern really kicks in, and you see the number of trades per month. So it doesn't catch every gap continuation and reversal, and there might be better ways to do that, but this is a strategy that I have found working with. And I'm going to show you a shorter time frame for this strategy. We're going to go over the other strategies today. So this is a mini webinar type video, sending this out to the All Strategy Access clients, putting in the portfolio calculator, working on that, and also maybe incorporating some of these in to some of the other portfolios. So I'm going to show you a shorter window for this as well. So taking a look at this, going back to the time frame February 1, 2016, when this strategy starts to work well, and you see here the equity curve looks much better from February 1, 2016, and prior to that it doesn't do terrible. Drawdown is much lower. This is with slippage and commission, 57.25 max drawdown, 124 average trade profit. Here is the performance summary, and this is gap continuation in reverse, E-mini S&P. Let's take a look now at one of the next strategies we're going to take a look at.